This is the video lecture on the income statement. Now, the income statement is one of the four main financial statements. And in this lecture, we're going to talk about the income statement in more detail than we've ever talked about it in previous courses. Now, first of all, what is the importance of the income statement? What do we get out of it? What are the uses? Well, there are several uses, but specifically, it does allow us to evaluate our past performance. We can look back at all those years in the past and look at all the income statements, and it will tell us how much revenue we brought in, how much expenses that we had to pay out, and ultimately whether or not we made or lost money. So it will help us to evaluate our performance. How well did we perform in previous years? How poorly did we perform? These are things that can be answered by looking at those past income statements. It also provides a basis for predicting future performance. In other words, we can look at the past and that'll help us understand what may happen in the future. Are there certain years that we tend to make more money? Are there certain times of the year that we have higher sales than usual? Are there certain times of the year that we usually have low sales? So even though things can be unpredictable, to an extent, there are certain patterns and certain things that we expect to see. So that's why it helps us with predicting our future performance. And it also, to some extent, will help us look at the risk of our cash flows, how much money is going to be coming in. Although really, to be honest, we have a better statement for that, which is actually the statement of cash flows, which will give us a even better idea of our future cash flows. But to some extent, the income statement does show that as well. So overall, it's a very important and very useful statement in accounting. But like anything, it does have its limitations. So what are the limitations to the income statement? Well, first of all, there are certain income items that are simply very difficult to measure. And as a result, we have to utilize different methods. So think about it. We have different methods for depreciation. We have different methods for inventory valuation. And those things have an effect on our income statement because when we record depreciation, that's a depreciation expense. Well, that expense shows up on the income statement. Or when I record the value of inventory, that is a cost of goods sold. That's an expense. That shows up on the income statement. So depending on the methods that I have selected, it will change the information. And as a result, it makes certain items difficult to place a value on. And also, it does involve a certain amount of judgment. And that's always a problem. So many of the things that we do in accounting are very objective, but sometimes judgment is involved, especially when it comes to depreciation. We base our opinion of the useful life, the salvage value, all that goes into the calculation of depreciation. And there's other areas of judgment. When we estimate our bad debts, bad debt expense, again, that goes on the income statement. That's our judgment. That's our opinion about how many of the debts are going to be bad. So it does involve, even though a lot of it is objective and very cut and dry, the income statement does involve a lot of judgment, and sometimes that judgment could maybe be a little bit suspect. Now, one of the things that we always strive for on our income statement is total accuracy. And by being fair and being very accurate, that leads to a certain condition that we call quality of earnings. We want people to have faith in our financial statements. We want them to look at our income statement and feel confident that it was prepared accurately and fairly. So if we always strive to do that, it's going to maintain our quality of earnings. It's going to maintain that image that they can trust and they can rely upon that information that they see in that income statement. Now, there are actually going to be different versions of the income statement. And up until this point, the version that we've always worked with, even though we haven't really identified it as such, it's been called the single-step income statement. So those of you who have already completed your Principles of Accounting 1 and 2, you're very familiar with the single-step income statement. This type of income statement is very simple, very straightforward. The calculation of income is a single step calculation, and it's also a version of the statement that conforms very closely to the profit equation. And if you want to take a look at that profit equation, here it is. Revenue, all the money that we're bringing in, minus expenses, all the money that we're sending out, and that answer will either be positive or negative. If we have a positive answer, we've had a net income. If the answer is negative, we've had a net loss. And the single step income statement adheres exactly to this. You'll have a section with all the revenues grouped together. You'll have a section with all the expenses grouped together. And there will be a single calculation, revenue minus expense, that will give you the final answer of the either net income or net loss. So that is the basic version. And that's a very popular version because it's simple, it's straightforward, it's easy to understand. And some people appreciate that. Some people appreciate being clear and concise and to the point. But if we don't want to do that, we also have another option. And this is one you probably haven't seen before. This is called the multiple step income statement. Now this version is a little bit more elaborate and definitely has a lot more detail. And when we calculate the net income, it will actually require multiple calculations. And this follows a very specific format. It has a lot more detail. Now in the end, whatever we end up with for a net income or a net loss, that's going to be the same whether I use the single step or the multiple step. So really it's just a question of presentation. And if you want to have a presentation that shows this additional detail, then you can utilize this format. Now when you see a multiple step income statement, it has a lot of sections that are different than a single step. And not every single business is necessarily going to have all of these sections on every single income statement. Only if they actually had events or transactions that would fall under these categories. So potentially you might see every single one of these categories: the operating, non-operating, income tax, discontinued operations, extraordinary items, and earnings per share. So we're now going to talk about each one of these sections in a little bit more detail. So first of all, the operating section. Generally, you will always at least have this section. And this section is where we report the general day-to-day activities of the business. So we're going to have some type of a revenue. And it could be that it's a service company, a merchandising company, so it could be sales or revenues. But that would definitely be included. Then we would have a cost of goods sold, which shows the cost of the product that was sold. Then we would have various selling expenses, and we would identify those in their own section. Then we would have various administrative or general expenses. So all of this information would be included under operating. And basically the general rule for operating is, what is our line of business? Are we a merchandising company? Are we a manufacturer? What are we selling? Whatever our main day-to-day business is, all of those events and transactions go in the operating section. Then we might have potentially a non-operating section. You don't always see this. You would only see this section if the business had something that needed to go in this particular area. And this is a secondary business activity. So this would be both positive and negative. Whenever you see revenues and gains, those are positive because money's coming in. When you see expenses and losses, those are negative. That's money going out. But the key word is that they are other. In other words, this is not our primary business. So for example, if you back up and look at operating, say that I had a fast food establishment. That's my business. It's a fast food restaurant. Buying and selling of fast food, that's my main operating activity. That's my main business. Those transactions would go here. But let's say that in my business, I have an appliance, and I decide I'm not going to be using this appliance and I'm going to sell it and make money, well, that's not normally what I do as a business. I don't normally buy and sell appliances. So that would be a secondary business activity. It would be a slightly unique situation, something that is not my main line of business. So if I did something like that and I had a gain or a loss from it, it would go under this non-operating section. But then again, if that's my main line of business is selling appliances, then actually that would go under operating. So when I use an example like that, it's not the type of business activity, it's the type of activity in relation to the main activity. But the main idea is that main business activities go under operating, secondary activities go under non-operating. Then we have an income tax section. That section is going to detail the federal and then maybe even possibly state and local taxes if we have to pay those. For the business, that information will be in its own separate section. Then we have discontinued operations. Now this is not something that you see very often. Again, this is another one of those sections that we would only have if we actually had an event that belonged in this actual section. So this only happens if the business decides to do away with a segment of its operations. So say we have a diversified company and we decide we're going to do away with our oil and natural gas segment. We're going to get rid of that segment and focus on coal instead. Well, that would be discontinuing a segment of our company. If we do that, we'll either have a gain or a loss from discontinuing that, and this would be separately identified in this section. So this would only show up during a year in which you had something like this happening. Then we're going to have a section for the extraordinary items. Now, an extraordinary item, we're going to reserve this section for items that are truly of a very unusual nature. Because think about it, if an item is not unusual, then it just belongs in the regular operating activities section. But if something happens that is unique, it's going to go in here, so that way we can draw attention to it. So for example, if I had a business and we sustained earthquake damage, that's a pretty unusual thing, especially in certain areas of the country. So that would be such an unusual item that would go in this section to highlight the fact that it is unusual. But then again, it's all based on context. If you had a business that was located in the state of California, for example, having earthquake damage is not unusual, it's an everyday occurrence. So that would just go under the normal business activities. So it does have to be something that is truly of an unusual nature in order to put it in this particular section. And then finally, the last section is called earnings per share. And earnings per share is where we have an opportunity to show how much money we made as a business per share of stock. And in order to utilize that, we actually have a formula that we utilize for the earnings per share. And by calculating this, it enables us to include this information in our income statement. And it's a fairly straightforward formula. We start out with the net income minus preferred dividends, and that's assuming that they have preferred stock. A lot of companies don't, so if that's the case, you can just leave that out. And then you divide by the weighted average number of shares. So net income minus preferred dividends divided by weighted average number of shares. That will give us the earnings per share, and we will disclose that as the very final section of a multi-step income statement.